Welcome back to Financial Fortitude, the show where we help families, professionals, and business owners balance living well today while planning wisely for tomorrow. I'm Michael Acosta, joined as always by my co-host, Brady Hemmerly.
Today we're diving into a topic that parents, grandparents, and even aunts and uncles are curious about: 529 plans.
These education savings plans get talked about a lot, but not everyone fully understands how they work, which states actually give you extra tax benefits, and the potential pitfalls to avoid before you open one.
So if you've ever wondered whether a 529 is right for your family's college savings or how to maximize the benefits, you'll want to stick around.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, this conversation is something that often arises in our client consultations, especially for younger families who are either starting to have children, maybe haven't worked with a financial advisor before and already have children, or even with pre-retirees and retirees who have grandchildren or great-grandchildren that they want to be able to gift from a warm hand to be able to help from a higher education planning standpoint. And it's often, hey, what is the best type of account registration or the best type of account that I should open specifically for covering higher education? And oftentimes the 529 savings plan is what comes up.
Yeah, it's something that we see often, right? If I were to think through goals that come up most for clients that we work with, it is retirement planning is typically towards the top of the list. Home purchase planning is typically at the top of the list. And if we've got a family or considering building a family, it's always college planning, right? Especially with how expensive higher education now is, there's this looming, how am I going to pay for it question? And oftentimes the easy solution or the first solution that pops up on Google is a 529 plan. So I guess where we start this is tell us a little bit more about what a 529 plan actually is and how it may be a little bit different from a normal investment account that we're used to seeing, a brokerage account or maybe a 401k account.
Yeah, of course. So I'm going to go to our trusty Investopedia website just to get a specific definition. And so what is a 529 plan? Well, these are higher education plans that are tax advantaged, and their purpose is to fund children's education. So what's going to happen is that from an IRS perspective, parents, guardians, grandparents, aunts, uncles can open up a 529 plan for the benefit of a child. The child can actually have the account open in their own name. And the sole purpose of these funds or contributions that are going to be made to this account are for higher education. Now, that's been expanded some over the course of the last couple decades, where it can be used for K through 12, four-year college degree, and even postgraduate, right? So graduate school, master's programs, things of that sort. And the real benefit of these is that they're, on average, double tax advantaged. And what I mean by that is you make a contribution to the 529 plan. It's invested very similarly that you would invest funds in your 401k, right? The 401k, the purpose of it is to save for your future retirement. Same mindset. This is specific to future higher education costs for your children. And so it can be invested in either a target date fund or a mix of, risk-based portfolio funds. And any growth that occurs in the account is tax deferred, meaning that you don't pay any taxes on it as it's growing and compounding. All right. Now, when you take a distribution from the 529 plan and it's used for what's considered a qualified education expense, you do not have to pay any taxes on any distribution combination of principal that you made to the account, plus any growth that you experienced over the course of having the funds in the account. So again, double tax advantaged. Now, there are situations where it could be triple tax advantaged, and that's when the state in which the account holder lives actually receives an income tax deduction for contributions made in a specific year. So in that situation, it's very similar to a health savings account where you make the contribution in a specific year, you get to deduct up to a certain percentage, maybe 100% of it on your taxes. The growth is tax deferred, so you're not paying any taxes on the growth while that's occurring. And then when you take the distribution for a qualifying education expense, it comes out tax exempt.
So let's demystify some of the stigma then, because I think the question that we get oftentimes is, how am I going to pay for college? And the first thought is, I'm going to use a 529 plan to do it. That is a college-specific account, so I have to save in a college-specific account. I think where oftentimes we pause to demystify some things is, let's answer the first question, how am I going to pay for college? Right? It's appropriately allocating and saving dollars for the future. Regardless of what account money's in, you're going to pay for college using money that you've saved or money that you have. So oftentimes the initial education that we're giving is, you can pay for college expenses from your bank account. You can pay for college expenses from a 529 plan. You can pay for college expenses from a brokerage account or even a 401k if you really wanted to. The 529 plan itself is not, hey, I have to put money here because it's earmarked as a college account. The 529 plan is primarily a tax-advantaged play. Do I have that right?
Correct. So for anyone who's wanting to be overly tax advantageous with how they're saving for college, a 529 plan could make a whole lot of sense.
Okay. So I'm putting money into the 529. Depending on what state I live, I'm maybe getting a tax benefit. Once the money goes into the 529, it begins to compound and grow tax-free during that time frame. And then if later those costs that are coming from the 529 are qualified, I get them tax-free. So what kind of advantage does that offer to people who are using a 529 as opposed to a bank account or a brokerage account?
Yeah, well, a couple benefits there. One is how these dollars are going to be realized on the financial aid application, the FAFSA, if parents are going to be applying for any sort of financial assistance by way of student loans, right? Maybe they've saved some, but they haven't saved all of it. That's required for the tuition. And we can break down those numbers here in a second of what the cost of tuition might look like in the future when someone's child is ready to be entering their 4-year degree as a freshman. So one is, how it's going to be accounted against them on the FAFSA. 529 plans are a little bit more advantageous depending on who the account is registered in, right? So think of having the account registered in a grandparent or an aunt or an uncle, someone who's not specifically a parent. With the Secure Act 2.0, there were some changes made to where it's a non-counted asset as far as included in the FAFSA against you. If it's in the name of a parent, it's going to be counted against the borrower or the student at a percentage of maybe 5 to 6%, somewhere in that range. Now, if it's in the name of the child, it's going to be counted against them a little bit higher, right? So greater than 6%, which isn't great because it just shows that there's more means to be able to cover the cost of tuition. But in essence, the idea here is that with the 529 plan, if you put, let's just say over the course of 18 years, you've contributed $50,000 and it's grown to be $125,000 or $150,000. If you have to use all of that for 4 years worth of higher education and their qualifying education expenses, all $150,000 comes out tax exempt. Now, on the flip side, what if I have a brokerage account that has $150,000 and that I want to liquidate and pay for the cost of tuition? Well, in that scenario, you're going to run into some sort of tax liability or tax implication. And it's either going to be short-term capital gains, long-term capital gains, or a combination of the two. Again, you put $50,000 in and it grew to be $150,000. So now you're dealing with $100,000 in gain that will result in some sort of taxable event when you file your taxes.
So effectively, in that case, the advantage is my dollar is stretching farther to pay for education expenses because I do not have to effectively worry about the tax bill that's associated with liquidating other investments as long as those expenses are qualified.
Correct. And again, I like to associate it similar to a health savings account. There are certain medical expenses that qualify, right? Certain things that you can go buy over the counter, certain procedures or professionals that you can go see from a medical perspective that qualify, and others that don't. So when you think about what a 4-year degree experience might look like, if we compare going to, where I went to school, Wingate University, the housing was on campus, right? It was all baked into the tuition and room and board. So paying for that out of a 529 plan is pretty straightforward. But if you go to a larger university with like a college town, think of something like, University of Georgia, University of Alabama, University of South Carolina, Eastern Carolina University, where a lot of the students after the freshman and sophomore year are living off campus in apartments, well, then it becomes questionable as to whether or not the full distribution that would be taken from that 529 plan is actually considered a qualifying education expense. And this is where a lot of people can get caught off guard and they get hit with a 10% penalty and even having to pay some sort of tax on any of the growth above and beyond what's considered qualifying. And in that scenario, the qualifying education or the qualifying expense is making sure that the cost of rent or housing isn't greater than what it would be if you lived in a dorm on campus.
Okay. So yeah, let's pause here and talk about this because the federal government is giving individuals a tax benefit or a tax break of preparing ahead of time and saving for college. Not to say there's always a catch, but there's always a trade-off, right?
Correct.
So if I'm saving into the 529, my plan is to take advantage of the tax benefits associated. What are the risks or the trade-offs that me as the parent or even the student might be giving up by using this type of plan?
Inflexibility of use, right? We've talked about it a little bit here. For anything that's not considered a qualifying education expense, you're going to run into additional taxes and penalties, right? Very similar to if you take a distribution from your IRA or Roth IRA before age 59 and a half, if it's not one of the exceptions to the rule that would exempt you from an early withdrawal penalty of 10%. Same concept. So, when you think about the 529 plan, it's very unique to a specific circumstance or situation, right? You're very focused on committing to pay for higher education, either in its totality, whatever that MSRP cost might be, or making some sort of contribution with the hopes that your child or children are going to get scholarships by way of academics, grants, or athletic abilities. So, for us, it's a matter of, okay, well, let's not put all of our eggs in one basket, because if you fund a 529 plan for $150,000, but your children only actually need to come up with, let's just call it $100,000, well, now you have $50,000 in excess. So how you use that $50,000 is somewhat limited, but the good news is that the optionality for how it can be used has been expanded some with the passing of the Secure Act 2.0. And we'll touch base on that here in a second. So what I mean by that is traditionally it used to be, well, if you had $50,000 remaining, you could withdraw all of it, but you're going to get hit with some penalties and taxes, right? So you don't really have $50,000. You have $50,000 minus whatever those penalties and taxes might be. Now, the other option where you could preserve as much as, if not all of that $50,000 in excess, would be to change the beneficiary. If you have multiple children, not a problem. Maybe your second child's not as smart as your first child, right? Maybe they're not as athletically gifted. Maybe they go to a university that's a lot more expensive than where the first child went. Or if you don't have any other children, but your children are at a point to where they're having children, so now you're having grandchildren, you can change the beneficiary to them as well to continue to preserve not only the total excess value, but also continue to take advantage of the tax-deferred growth that ends up ultimately having the opportunity to come out tax exempt.
And I think those expansions are very helpful for college planning itself because traditionally, or at least more historically, 529s, as you mentioned, were more inflexible. Hey, if I don't essentially build this account perfectly for the needs that my child may or may not have in the future, I'm going to have a tough time unwinding any extra or this asset in general without a tax and penalty I otherwise could have maybe circumnavigated. But I think the two biggest risk questions that we often get from clients, and they're just disguised as more personal questions, is what if my child doesn't want to go to college? What if my child pursues perhaps a career that doesn't require a degree? Or what if my child gets a scholarship? And from what you've mentioned here is we have options, right, in regards to using funds in a more expanded lens for K through 12 education, for associates-like degrees. We have graduate-type degrees. We have options to use funds for other children without a penalty or tax associated. We have options to continue to hold on to the 529 and help benefit of even future generation. Your kids may have kids. So with all of that said, what are some of the more strategy-based thoughts or conversations that you're having with clients when it comes to thinking through, should I use one? How much? How should it be allocated? Like, there's 10 more different questions we could ask once we determine, hey, if it's even an option.
Yeah, so I think when you're planning for higher education, depending on if it's a brand new child, newborn, right, versus a child that's 7 years old, understanding your time horizon for when the child's going to be entering in their academic career as a freshman, right? Because that's going to show you how much you need to be saving each month, each year. Best case scenario if you're fully committed to funding this in some capacity. And then it's understanding, okay, well, what is the probability that not only my child attends a 4-year university or college, but also that they may or may not receive any sort of scholarships or grants or assistance? If you've listened to any of our other episodes, especially the ones focused on federal student loan planning or private student loan planning, I'm a big believer in leveraging federal student loans where we can to help offset the cost of this. But if we're looking at it from the lens of, hey, maybe we make too much income as a family that we're not going to qualify for financial aid, then it's okay, well, let's first identify the cost. What are some universities that you think your child would want to attend? Maybe you're someone like yourself who graduated from Clemson and you're very gung-ho on, keeping the family lineage of everyone's going to Clemson, right? Or is the child going to go in-state versus out-of-state? What's the conversation that you and your spouse have had about whether or not you're going to offer fully funding or providing a certain amount of funding if they go in-state versus out-of-state? I have some clients who say, hey, we will pay for your total in-state cost if it's a public university as opposed to private, because typically the costs are going to be less with public, at least on paper. But if you go out-of-state, we're capping the amount that we're going to provide you with at X, right? And I think that that's prudent. So if we just use as an example, just to look at in-state versus out-of-state, let's look at the University of North Carolina at Chapel Hill. And this is data from the living balance sheet through spring of 2024. So all in, if we take into account tuition, room and board, books and supplies, and other expenses, in-state cost summary is $26,109. Okay, so if my child is starting their freshman year in the fall of next year, 2026, then I can expect to need, if I'm going to cover the full cost, no scholarships, nothing, a little over $100,000 for a 4-year degree. Now, if this is an out-of-state cost, maybe it's someone who lives just over the border into South Carolina and they want to attend the University of Chapel Hill, then we're looking at just under $55,000 a year. So in that scenario, we're going to need a little over $200,000 to cover that full MSRP ticket price, right?
And those are two notably different plans when it comes to how much might I save in a 529, especially for the tax advantages, because at $100,000 or $200,000, it's where real tax advantages start compounding.
Right. And there's only a handful of states across the entire U.S. that don't really offer any sort of tax advantages or tax deductions when it comes to making contributions to a 529 plan. So it's just make sure that you're either speaking with your CPA or trusted accountant just to better understand whether or not you're required to make a contribution to your state-specific 529 plan. So for example, I reside in the state of South Carolina. If I want to receive a tax deduction on my annually for contributions made to my children's 529 plan, I have to participate in the state-specific plan. Okay. Now, if I live in a state like Minnesota, Maine, Kansas, Arkansas, Arizona, Missouri, Montana, Ohio, or Pennsylvania, I have the option of being able to participate in any 529 plan nationally, and the contributions that I make towards those plans are tax deductible in the state of residency that I am in, right? So a little bit more flexibility or optionality there as far as being able to choose a different money manager or fund provider who's overseeing and managing the state-specific plans.
So strategic tip number one is generally understanding, or at least having the conversation with your family, where might my child go to school? What options might they have when it comes time to go to school, in-state, out-of-state, private, public? How much tuition might we cover, or are we really adamant that we do cover? And then once we have an understanding of what that tuition might cost, then we start planning or considering the 529 as a component of our plan or the only plan for college savings in that instance. Let's say option number one, we're going to a public university. It's going to cost right around $100,000. Is the 529 the only solution, or where do we go from there, strategic-wise?
Yeah. In my mind, this is where the art of building a financial plan really starts to show itself, right? Because we've mentioned many times that financial planning is more of an art than a science. And so for me, I like optionality. I like clients to have flexibility. And I also don't want parents to become a financial burden on their children for the sake of dying on the hill of, hey, I funded your college and you didn't have to have student loans, right? It's very admirable. I can appreciate that, having 4 children of my own. However, is it in the cards? Is it realistic, especially with how much the cost of tuition has increased over the course of the last 3 to 4 decades at a relatively consistent rate of about 6% year over year on average? So let's just say that we have, from an optionality standpoint, let's say that we parcel it out into thirds. A third of what we're going to save is going to go into a 529 plan. Hopefully the state that we're in gives us triple tax advantages with deductions in the years that contributions are made. Put a third of it into maybe some sort of account that's jointly held between me and my spouse so that we at least get to retain control over it. Assets and countable assets towards FAFSA in the parent's name is counted at a lesser percentage than if it's directly held in the child's name or the student's name. So keeping it in the parent's name makes a whole lot of sense. And if you want to throw in another third, it's just understanding what other assets are not considered countable when it comes to FAFSA application or FAFSA assistance. Things like permanent life insurance that offers cash value, things like Roth IRAs, or things that would not be counted, and a couple others that you would want to do a little bit more research on just to better understand how you might leverage them and to be able to complement the overall plan. But nowadays, when I talk to clients that have children, a lot of them are starting to say, we don't know if we want to put all of it in the 529 because we just don't know if our children are going to go off to college. They might want to go into a trade. They might want to go into a military. They might want to just bypass a 4-year degree altogether, get an associate's, and maybe start a business. And I think all that is okay, but at least you're having the conversation. You can still save adequately. You just don't want to lose control over the asset and lose all flexibility of use.
Strategic tip number 1, understanding how much college might cost, how much parents may or may not be on the hook for, or at least want to help pay. Strategic tip number 2 is, the 529 is a component or complement in an overall plan. Going 100% in one bucket is really going to limit flexibility. So understanding how we're building the total plan and the 529 is a complement, helpful. I think one of the conversations we're often having with clients is it's a trade-off, right? It's important for me to fund my children's college education, as much of it as possible, but I also would like to retire one day as well. Talk to us about that trade-off, or how do I really prioritize college planning and the use of a 529 alongside of the goals that I may have for myself.
Yeah, I think this is where a couple things. One, any dollar that you decide to put in a 529 plan is $1 that you're potentially taking away from your future retirement, just because of the inflexibility of getting it back out without penalties and taxes, especially on the growth side of things. So understanding that, again, if you want to open up a joint brokerage account for you and your spouse, maybe for yourself, and fund aggressively into that, you can always later pay tuition from there, right? If you're a business owner, you can pay your children by way of putting them on payroll and paying them up to the standard deduction to, bypass having to pay income taxes, at least at their level. And again, you would want to consult with a CPA or tax professional who understands the IRS codes and when it makes sense by way of age and sector and occupation to hire your children. But you're basically shifting dollars from your self-employment tax rate of 35% to their non-existent tax rate, assuming that you're not paying them above their standard deduction of $16,000 for 2025, plus or minus, and saving yourself a large amount of tax liability. So you can be very strategic, but a long way of saying, hey, if you're going to be strategic around it, understand the total cost and whether or not you are okay with the risks that could be associated with it by way of potentially needing to lean on your children for financial support in the future if you have inadequately saved for yourself. So for me, I tell clients all the time, this is what we're trying to save at, right? We understand what an extraordinary wealth building rate is, 15 to 20% of your annual gross income. If we're not hitting that, aggressively funding a 529 plan may not be in the cards. Let's first put your oxygen mask on so that you can be, a help to others around you versus you just going gung-ho towards 529 funding and limiting your optionality. And now you're in dire straits when you're in retirement because, again, we didn't plan prudently or productively.
And I think one thing to consider there, especially yourself as the student loan professional, is student loans are very much on the table for college planning, either by necessity or by strategic choice. Many borrowers are going to have the option to leverage student loans in some capacity. There is no borrowing strategy out there that lets you take out loans for retirement. And I think that's oftentimes what we're reminding clients is, hey, we have more strategic options when it comes to paying for college. That may not look like you aggressively saving and effectively trading off what your retirement date looks like or what your retirement lifestyle looks like, because we can use the student loans as a tool. It's much more challenging to work your butt off to pay for all college expenses, only to either be surprised or maybe not surprised that, hey, my retirement doesn't look the same because of the efforts that I had put towards education funding.
We all know, anyone who listens into this on a recurring basis, that I'm more of a technical person. I'm more of the data nerd of the two of us. But if we just look at the numbers, it can be very daunting. So let's say that you have a child who's 3 years old, okay? And you're like, hey, I'm now in a position where things not nearly as chaotic. I want to start funding a 529 plan. Maybe my budget only allows $500 per month, right? $6,000 a year. Well, let's just say that I live in the state of North Carolina, and my child, I'm very bought into Chapel Hill as a university that I want my child to attend. Some greats have gone through there by way of sports, but again, it's a very strong academic school. So $26,109 per year for total cost, right? No scholarships, no grants. If I'm going to fully fund this, let's just assume that I have a 15-year runway until my child turns 18. Well, if the cost of tuition continues to rise at 6% year over year, that means that $26,109 is really going to feel like $62,572 per year. Okay, so multiply that by 4, total cost of tuition is about $250,000.
That's
right?
a scary number.
That's a big number, right? Now, if I'm saving $6,000 a year over 15 years, in order to end up with exactly the right amount, I would need to generate, on average, year over year, from a growth rate perspective, just under 12% year over year. Then the question becomes, what is the probability that I average that over 15 years moving forward? Like, what's my success rate going to be? How aggressive am I going to have to be from an investment allocation standpoint? Now, obviously, the more you're able to contribute, if you can get relatives and family members to make contributions, that will help lessen the burden. And, having children myself, the 529 plans that we use make it very simple to be able to, on birthdays and holidays, send emails out to relatives and friends and loved ones with a special note, encouraging them to make a contribution towards the benefactor, the child's future education versus buying a toy, something that's going to lose its glimmer after a couple play sessions, and then, it's off to the side, never touched again. So it can be a great tool. It's just, my opinion is that it shouldn't be your end all be all, and we don't want to put all your eggs in one basket.
So tip 1, understanding how much college costs. Tip 2, understanding that the 529 plan is a tool and a complement to a total financial plan. Tip 3 is understanding the trade-offs between how much is going in a more inflexible college-specific bucket versus a more flexible general savings or retirement bucket. I guess the last question that I have is, I'm using a 529. Just like any other investment account, the money's going to go in as cash. Now I have to determine how it should be invested. Talk to us about what strategies may look like there. Talk to us about how I should be thinking about how I put the money to work, because I've got to do it once it's there.
Yeah, every state-specific plan is going to be a little bit different as far as what fund options are made available, right? Not every single state plan is just going to give you the complete universe of investment vehicles to select from as far as ETFs or mutual funds. So if we look at the state plan of Virginia, that's managed and overseen by Capital Group, also known as American Funds. So they have specific funds that are risk-based, meaning, you can be ultra-aggressive or you can be ultra-conservative. They also offer age-banded funds that are very similar to a target date fund for retirees in a 401k. Now, instead of thinking about, okay, well, the fund in a 401k that's target-based is going to become more conservative over time as I get closer to my expected retirement date, the 529 plan fund that is age banded, as you get older and closer to age 18, which is typically on average when you are heading into your freshman year of college, it starts to shift from being more aggressive over time to more conservative, right? From a preservation perspective, trying to retain as much of what you've built up as possible. I have mixed feelings about it, right? So from a behavioral standpoint, if you're someone who wants to keep it very simple, putting it in an age banded portfolio isn't problematic. My only concern with that is it accelerates the move to being too conservative too quickly, and you miss out on desirable growth or compounding interest.
You miss out on compounding interest when its effects are at its greatest.
Correct.
Right. Most of the time, if I'm making contributions into an investment account, it's growing at, call it 8 to 10% a year. Those first couple of years, the interest or the earnings that I'm receiving aren't that flashy. Whether I'm getting 8% or 9%, the difference doesn't matter that much. But when I have $100,000 or $200,000 in an account, the difference between 8, 9, 10%, that's now thousands of dollars. So as Michael mentioned, keeping things very simple, it could make sense to put something or put some of those funds in a more target-based approach, but oftentimes that leads to taking risk off the table and losing that compound interest effect in the years that it really would make the biggest impact.
Right.
So again, at least the way that I'm hearing it from you is in isolation, those target date-like funds for education planning could be a good solution, but I think where you're probably headed next is in the artistic design of a financial plan. Having other buckets or resources to lean on may give you more options in how the 529 could be invested.
Exactly. And, when building these plans, it's often, okay, well, if we don't need all of it for college, we still might want to be able to help pay for our child's wedding or honeymoon or, deposit or down payment towards their first home, something to that extent. Now, one of the neat things about the 529 plan that's been expanded upon with the Secure Act 2.0 that passed about 2 years ago is that they now allow, currently, based on IRS rules, to a lifetime conversion amount of $35,000. So let's say that, again, you saved about $185,000 into a 529 plan. You only used $150,000 for 4 years of a degree. There's $35,000 remaining. Well, the IRS will now allow the benefactor of that account, right, the child, the student, to convert all $35,000 into a Roth IRA in their name. Now, it's subject to what the IRS annual contribution limits are to a Roth IRA, from the sense that right now in 2025, the most that an individual can contribute to a Roth IRA is $7,000 in a single year, assuming that they're not phased out by way of income. In this scenario, it would take 5 years for this student to convert all $35,000 into a Roth IRA in their name. So again, as a parent, you accomplished two goals. One, you helped fund their college, but two, you also helped jumpstart their future retirement needs.
All right, Michael. So as we begin to bring our episode here today to a close, what are some of the things that you'd like listeners to take away, if a few, from the chat that we've had?
Yeah, I would say it's never really too early to start having the conversation with your spouse or even your children around where they might want to go to school. I know me and my wife will often go back to our alma maters and, go to football games, go to homecoming, whatever it might be. And the kids really enjoy getting to be on campus and seeing where we went to school, where we used to live, things of that nature, where we used to play our sports. And so that's exciting, but also recognize that education has evolved and will continue to evolve moving forward. So if you're closer to your children going off to school, then those conversations really need to be had, and there needs to be some sort of expectation defined as spouses, as parents, and as children of saying, okay, well, if you're going to go in-state, this is what we'll provide. If you're going to go out-of-state, this is what we can afford to provide. Or, hey, we don't have the means to do so, so we're really going to have to rely on financial aid, meaning that it might be some sort of combination of student loans in the student's name plus maybe some student loans in the parents' names. If you are uncertain of how to design a college savings plan, working with a financial professional can definitely be fruitful, assuming that they have expertise in that and understand how federal student loans work, how the FAFSA works, and which vehicles make the most sense from a overall need perspective. I would also say, hey, don't put all your eggs in one basket. Retain some sort of optionality. Maintain some sort of flexibility and control of your overall assets, and use a combination of maybe 1 to 3 different types of account structures or vehicles or things that are available from a college planning perspective. And then the last thing is, don't put too much stress on yourself about this, right? If you're having to move money from your individual or jointly held brokerage account to fund college, or if you're having to pay from payroll to fund tuition, that's perfectly fine. It doesn't have to be in a 529 plan for it to be considered a successful college planning strategy. We just have to have the capital available on our balance sheet to cover the cost of tuition for that education.
So, Michael, in summary, 529s are very powerful tools, especially from a tax perspective. But like everything in financial planning, the right move depends on your situation, your state's rules, and generally your broader goals.
Correct. Don't just open one blindly because you heard it's what you're supposed to do. Make sure it fits within your family's overall financial strategy and overall objectives.
And thanks for tuning in today to Financial Fortitude. Be sure to subscribe, share this episode with a friend or family member who's saving or thinking about saving for college, and leave us a review to help us reach more listeners.
And if you'd like us to tackle a specific question on a future episode, please visit our Ask Me Anything page at www.genesiswealthplanning.com/AMA.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady Hammerly are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hammerly's California Insurance License Number 4353077 7237198.19 expiration 1027.